This is how the banks do it to us. So we are taking back that banking function. And you could tell I'm fired up about it because this is what you guys need to do to get ahead. Simple as that. Hey guys, and welcome back to Life 180. My name is Matthew Branch with 48 Financial. I am a licensed insurance advisor and also IBC practitioner, unauthorized IBC practitioner. I practice it in my life today. And I caught hold of this this concept about a year ago, and I've been doing everything in my power to get around the people who are practicing it, teaching it, showing it, and I kind of ended up here honestly by luck, and now I'm talking to you guys about it. So basically, today we are going to be talking about opportunity cost and what that means to you. And, just kind of having a conversation around that. Obviously, I'm not talking to anyone in this video other than myself, kind of just, talking directly to you guys, how it's impacted me and how I can possibly help you guys out, save so much time and hassle, really, and really take away the risk of investing your money into the stock market. I'm not saying investing in the stock market is a bad thing, and a lot of the times investing is always the right option, but the idea of more risk, more reward is just totally obsolete. And the infinite banking concept shows you how you can really reduce the risk of investing while capturing all that compoundability inside your whole life policy and having the most opportunity to access your capital to go and invest. So I hope that made sense, and let's hop right into the video. I'm going to be showing you what opportunity looks like and what you're losing, whether you're saving up to buy a new car or using credit to buy that new car, or using the infinite banking concept. I'm just going to draw it on the whiteboard, nice and old-fashioned. I could have done a diagram on the computer, but I think this is way easier, and it just shows you how simple this concept really can be. So this is something my mentor Liz does a lot with clients, but she obviously draws it on the computer. I'm going to make it super simple and draw it on the whiteboard here. This line represents your life. Let's say every 4 years you are purchasing a new vehicle. So when we go to save up for that certain thing, like storing our money into a savings account, saving up to buy a new vehicle, this is what your money looks like. It will grow. You purchase that car, and it crashes, right? You buy, or you save, you buy, you save, you buy. This is what most people think is the best way to purchase a car. Now, there's also financing option, or using credit to buy something like on a credit card. This is your life. You use credit, you pay it back. Use credit, pay it back. Use credit, pay it back. This is really how simple it is, guys. This is what people do. This is how people think they have to live their life, right? Now, there's also the third option. Okay, so my example. So this is how the infinite banking concept works. We have our lifeline. This line represents our life. I'm gonna make it a little bit bigger here, right? Let's say we put a policy on our life, and it starts growing, right? It starts growing steadily. All right, and like the other examples, we had expenses here, 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 here. This is when we're buying our cars, right? Every 4 years or so. We are going to get a policy loan, and instead of our money dropping, it won't drop because we are loaning out our money and paying it back. Loaning out our money, paying it back. Loaning up our money, paying it back. Loaning out our money, paying it back. Loaning out our money, paying it back. Even though we are dipping, we are still growing money because we have taken back that banking function. Instead, we're not saving our money, right? We save up and we lose it. We save up and we lose it. We save up and we lose it. This is cash. This is cash. This is IBC. And this is financing. Or credit. If you guys can see that at the bottom, this is credit. So boom, 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 boom. It's as simple as this. That's just one little thing I like to do. I know this might be a little bit confusing to some of you guys, but how this relates to opportunity costs, if you see the infinite banking concept method here, we are not losing the opportunity of buying this car every 4 years. I know this is not equal to 4 years, but let's just say, because that's like the average time someone will spend between cars and before purchasing a new one. But yeah, so let's check out the cash. This is what most people do. This is what most people think. Or sorry, most people finance, but this is what the best thing people think they can do. So they right here is when they're buying their cars and they lose this. This is what really destroys their compounding over the years. So while their money could have been doing this, like up here, they are dropping all the time because it's just obsolete, guys. This is the worst possible thing you can do with your money. This right here, I guarantee you, is the best possible thing you can do if you are someone who is responsible with your money, doesn't gamble it away, is decently financially literate. The IBC method is number one because who doesn't want their money growing? Ask yourself that. Do you want your money growing? Because every other way, you're either paying money back to the bank here, you're paying money back to the bank, or you are paying yourself right here. So you're paying, the companies, you're losing all this compounding, or you're paying money back to yourself. So you lend yourself money, pay it back. You lend yourself money, pay it back. Lend yourself money, pay it back. This is how the banks do it to us. So we are taking back that banking function, and you could tell I'm fired up about it because this is what you guys need to do to get ahead. Simple as that. Let me show you something on my computer that might also change your perspective. This is why we lose opportunity. Sorry, not this. The cash method and credit method is why we lose opportunity cost and what our money could be doing for us on the back end while we're sleeping, while we are just chilling with friends, whatever it is. The thing I want to show you guys is what it would look like putting a whole life insurance policy on a 4-year-old. So as you guys can see here, this is also, by the way, a calculator that we use with clients. This is the best representation of what a whole life policy looks like at base value. So right now we are putting in 25. Actually, we'll put in 10,000 just to make it simple, so it's not a lot, nothing overwhelming. And we're gonna fund this for life because I think once everybody really grasps the concept, you're gonna want to fund it for life. That's what provides the most value for you and the people after you. So we're just going to look at purely the deposits and cash value today. In a normal savings account, you will have, the deposits is what it would look like. Let's keep in mind, the deposits is what you would be contributing. This is all you would have left, is the, 50,000, 100,000, 150, whatever, blah, 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 blah. That is what you would get. With the cash value, this is what you get. This is what you actually get because they take your money and they invest it for you in very guaranteed investments. This 48,000, though you have lost 2,000, you have now made a situation where your money will grow while you can leverage this 48,000 as collateral using a policy loan. These will all be able to, you'll be able to access this every time because the policy loans. And that is where you gain the most opportunity. What can you do with 419,000 or 90% of 419,000 at age 65? And this, as you guys can see, only goes up to 8, or the lowest it goes is 40 years old. So, I mean, it's still young, but at age 45, what kind of business can you put a down payment on for with a loan of $48,000? And that's not even the best part. The best part is that this is continuing to grow. It doesn't come out of your cash value. It's collateralized and given to you by the insurance company. And that is what true opportunity cost, this is what you lose if you just start saving your money. This is what you will have. I would much rather have, $2 million to give to my family than, whatever this will be. Let me see. Than 600,000. That's over double, guys. And that's just my opinion, and that's what a lot of people would choose. I hope you would choose control of your money, more money, and better legacy for your family after you. Less taxes, more control, more money. There's nothing wrong with this concept. Anyways, guys, that's all I have for you guys today. I hope you guys have taken from this video something. If it was something small, make sure to subscribe, because we are pumping out content like crazy. I know Chris is working hard, and 4A Financial and all the advisors are working super hard to get out content and bring value to you totally for free. So make sure to subscribe to the channel, and if you guys have any questions, you guys can reach out to Chris and he'll get you in front of one of us at 4A Financial. If you guys are Canadian, we are doing this for Canadians only, but I know Chris has a lot of Canadian viewers. So yeah, guys, I hope that helps you guys out with opportunity cost and how IBC can help you take back that banking function, take back control of your money, earn you more money than just saving it, and give you more opportunity in general. So yeah, that's it for me, guys. My name is Matt, and I'll see you in the next video.